Well, hello, DMAR members. We're here for another virtual presentation. I am Ewan Graham, your current chair for DMAR for 2019-2020. Today, we're going to do an economic Q&A focusing on the local and national trends. We have two guests with us. We're lucky to have Patti Silverstein, President and Chief Economist of Development Research Partners, and George Ratiu, Senior Economist with Realtor.com. So let's jump into it. Patti will be providing more of a Denver/Colorado perspective, while George will have more of a national view on the economy and the housing market. So we're going to run through some questions and let's go for it. So let's jump into the obvious. What have you seen the COVID-19 pandemic changing in the housing market so far? Have you seen anything that you can enlighten us with? Patti,
I think obviously the biggest change is the way homes are being sold right now, or being bought and sold. I mean, obviously we've had to shift very quickly to a whole virtual format for the house showings and the house tours and that type of thing. And so that has obviously been the very biggest influence, I think, on our whole housing market.
George, what would you say?
Yeah, absolutely. I would echo Patti's remarks. If anything, I would say that on a pragmatic level, the technology that a lot of real estate companies were already working and planning to implement has simply been sped up, right? So the pandemic forced a lot of companies to adapt a lot faster than they might have done otherwise. The other thing I want to mention is that, at least from a national perspective, we have seen the pandemic impact making it a little bit difficult to conduct transactions. And so what I mean by that, number one, we started the year already undersupplied. By calculations we ran at Realtor.com, we were about 3.8 million homes short based on household formation numbers and new supply. And so what the pandemic has done, rightfully so, spooked a lot of sellers. So they yanked their homes off the market, or possibly delayed putting them on a market right in the beginning of the spring season. So the inventory situation right now is extremely tight. So I think that is making, in many markets, price discovery a little bit tricky. I wouldn't say impossible. It's just that for some sellers, they're rightfully asking what is the right price in the current market. At the same time, we're seeing buyers still interested. If anything, the other thing that we saw for housing market is whereas buyer interest is still there, lender interest, and we can touch upon this a little later, lender interest now is a lot more cautious.
Yeah, I think that's a really good update in terms of what we're seeing in our local market, and I can just add some flavor to that as well, is definitely a huge undersupply right now. And since we've been allowed to start showings in person again, we've seen multiple offers due to the fact that we just don't have enough supply in the market. But what I would like to touch on there is, do you think that in terms of the housing market and, in line with the economy, are we just going to see a later spring season, or do you think this is going to continue for the foreseeable future? What do you see? What are the metrics you're seeing out there? Patti?
Well, I think that here in the Metro Denver region, unfortunately, I think that this whole second quarter is just going to be ugly. I think while we're starting to see businesses reopen and people heading back into the office, back into work, I think that there's still a large fear factor that we are dealing with here. And I think that is going to make certainly this whole second quarter be a little bit ugly, and starting to see some improvements towards the end of the third quarter and into the fourth quarter. So I guess while I totally appreciate that we have an undersupply of homes on the market, that it still is a very tight housing market, I just think that that whole fear factor is going to play into the whole housing market a bit here for the next couple of months yet.
Fair point. I would absolutely echo your comments, Patty. And I think that really you see that nationally, granted maybe with some variations across geography, but you're right. And it's not just the health factor that people are fearful and concerned about. It's broadly speaking the economic and specifically the employment landscape, which is really scaring a lot of people, right? We saw this morning, in fact, right, an additional 3 million almost initial unemployment claims just for this past week. So in a span of 8 weeks, we are basically over 36 million Americans having gone to the unemployment line, so to speak. So that is absolutely making an impact on housing. And to your point, when you look at the degree of activity, at sales, at contract signings during this periods, April, now we're halfway through May, absolutely sales are going to suffer during this second quarter. We see a slight pickup during the late summer months. For a lot of people, they still have to move, right? Either for job reasons or maybe for retirement reasons. So some folks are still going to look to make a move, but you're right. We see a rebound in late summer, but then a decline going back into the winter months, partly due to seasonality, right, colder weather, and partly due to a lot of economic uncertainty.
I want to add that local flavor where you had mentioned just the initial unemployment insurance claims at the national level. Here in Colorado, we have about 451,000 folks that have filed for that initial unemployment insurance, and about 60%, give or take, of those folks are located within the Metro Denver region. So it is certainly significant. Now, the hope, however, is that a lot of those folks are temporarily on the unemployment insurance rolls, that they will be called back to work, but we don't really know just what percentage. So, you know, if Colorado is following kind of national trends, roughly 75% of those folks are temporarily unemployed, will be called back. But of course, that's, you know, we will see how those callbacks actually go once we get the economy rolling again here.
So let me ask you, in conjunction with the talk about unemployment claims, how do you see that spiking in the near future, or do you see this a continuation throughout 2020? And how you know, for future reference in terms of how long does that recovery take, in terms of, is this just a short-term temporary thing where people will come back to work quicker than, you know, past you know, depression times that we've seen, or is this going to be a longer-term thing that is going to impact real estate on a longer, you know, in a longer-term basis?
Well, the good news here in Colorado is we are seeing those initial unemployment insurance claims ticking downwards week after week. So after spiking kind of at the end of March, beginning of April. So that's very good news. I mean, a lot of those folks that were going to be unemployed because of this have hit those rolls already. Not that, I mean, I still expect we're going to see large numbers of folks that are still filing for unemployment insurance claims. You know, right now in Colorado, we're at around 30,000-ish per week. And in the Great Recession, we saw something like 5,000 to 10,000 per week. So we're still at a very high level. And we expect to remain at that high level, at least, in my opinion, at least until we get in kind of the mid third quarter.
That's interesting. And from a national perspective, when you look at the pace of unemployment claims, it seems to be stabilizing. But really, that's sort of saying, well, it's not as terrible can be. You think about the fact that the pace of unemployment claims prior to the pandemic was running at about 250,000 nationally. We're looking at 3 million this last week. And that's really the slowest pace, at least over the last 8 weeks, right? It was even worse than that. And so from my perspective, I see that the impact will linger longer than most people expect. I think the initial expectations were that this might be a 2-month shutdown followed by a quick spring back. The trouble I see is the initial hit was clearly centered in the food, restaurant, air travel, lodging industries, but we are now seeing secondary effects. We're seeing manufacturing companies, we're seeing technology companies, we're seeing other companies in the broader economy, which are now resorting to cost-cutting measures and laying people off. And these are not jobs that are likely to rebound and come back as quickly as maybe those in the restaurant industry. So from that perspective, I think that the recovery will be longer than, if anything, most people anticipate. And for the housing market specifically, I think that we're going to see a relapse into the late 2020 and early 2021 before we might see a more sustained recovery.
So that's an interesting point, because I was going to ask about that in terms of the travel, hospitality, restaurant industry, where we know we've seen huge layoffs. And I'm hopeful that, based on the fact that we've never had this shutdown period ever before, where you've never been able to go to a restaurant, or your air travel has been severely restricted, that hopefully that when we start seeing things come back in some normality, whatever that new normal is, that these jobs will reopen and we'll see the unemployment figures start to come down. But in terms of that, the buyer pool out there, do you see, in terms of people that are still looking to buy homes, do you see that strong and to be continuing to be strong, or do you see the trickle down effect? Like you're saying, manufacturing jobs are starting to be lost. It's really impacting other industries. Do you see that, in the next 6 to 12 months, impacting the ability for people to buy housing?
Absolutely. I mean, kind of echoing on what George said, I mean, we are seeing that the initial unemployment insurance claims are hitting every industry. Yes, it started very much so in the whole leisure and hospitality sector, but is starting to trickle through all throughout the various industry groups. I think that when it comes to residential housing, though, I mean, everyone still needs a house, and we are still going to have movement of people. I think the question is just how much mobility will we continue to have? How much cross-country mobility will we continue to have? And where are those people going to be moving? And there's a lot of different thoughts out there. Some folks saying that rural areas are going to be the place to go, that you're looking for less density, versus others are like, no, people are going to want to be within more urban cores, central cores, because that's where the concentration of jobs might be. That's where it's more walkable, bikeable. You don't have to depend upon transit as much, that type of thing. So I think that there's going to be some shifts as far as where we see people moving, and because everybody is going to have kind of a different level of tolerance for our new normal, if you will. And so that's going to influence it, but I think we will continue to see here, at least in the Metro Denver region, that we'll continue to see strong demand, although I do expect that home sales activity will be a little bit lower than what we have experienced in the past year and all.
So from a national perspective, piggybacking on Patti's remarks, I'll add that there are a few insights that we've gotten recently. So in April, we ran a survey of consumers, specifically asking them about, number one, now that they have been in quarantine across the country for several weeks, what did they come to value in their current home? What were the shortcomings of their current home? Two, what were they looking for potentially in their next home? Interestingly enough, it seems that on balance, most of us agree that when we have to work, exercise, cook, teach kids, and do all kinds of other things at home, none of our homes are nearly big enough. So that was one of the first remarks. And interestingly, springing from that, it seems that for most consumers, at least based on the sample we use, the national sample, most of them in their next home, when we ask them to rank, what are the top few things that you would like to do? Number one, more space right off the bat. Number two, more outdoors access and space, whether it's a yard, whether it's a patio. Clearly, being in a downtown core in a high-rise building is not very helpful in a period of pandemic. And number three, not surprisingly, now that most of us are cooking at home more, was an updated kitchen, right? So just from those insights alone, from my perspective, it seems that we will see demand for homes, at the very least, increase in the suburbs. And this is not a new trend. If anything, for the last 3 years, I've been saying that, 10 years ago, 8 years ago, 7 years ago, the mantra was the suburbs are dead. So the last 3 years, I've been saying, well, the suburbs are dead. Long live the suburbs. Why? Well, it turns out that suburbs have become more popular even with younger generations for simple reasons. They're getting older. We talk about millennials, right? The largest generation in the history of the United States. We've been talking about this generation for the past decade now, is the renter generation. They'll never own anything. Well, yes, if they were 22 years old, yeah, they wanted to live downtown. But the oldest of them now are about 38. They have kids. So they obviously, number one, need more space. Number two, want more space. So my view is we're going to see continued demand. Number one, within the suburbs, so close to where the jobs are, but not in the downtown core. Number two, to smaller and in many regards, actually mid-sized cities outside of large metropolitan cores. In most big metro areas, like San Francisco, New York, DC, even Denver, right? You have all these cities around like Colorado Springs and some of the others where you can get to relatively easy. And in the current environment of remote work, those cities are going to become a lot more attractive. And look at the fact that we have a large number of companies, whether it's tech companies, Google and Facebook, Microsoft, announcing they're going to allow their employees to work from home for the rest of this year. You now have big university system. Look at the Cal State system in California, which basically has placed its entire fall semester in an online environment. So all of a sudden, for a lot of employees, there's not a need to be in a particular location. So I think we'll see some of that drive demand going forward. And the one nuance I'll add, today's suburbs in smaller towns or even mid-sized towns don't look the same way they did 10 years ago. And I know you see this in Denver and the Colorado areas. Think about the fact that for many suburbs, we've seen what I've been terming the emergence of the suburban downtown. We're looking at mixed use, residential, commercial mixed together, mid-rise 6 to 8 story apartments or condos. At the bottom, you see restaurants, you see retail, you see experiential, retail, parks, green spaces, walkable spaces. So for young people, particularly, the transition from an urban environment to a suburban one is much more seamless as a result of that.
That's a good segue into what, because I'm going to come back to a couple of things that I wanted to touch on the economy. But with that being said, and George, you can follow up on this, and then Patti can answer it. What do you see this pandemic making a big enough impact in the way we think about housing, and in the way that the developers are going to think about housing, and the way that housing is going to look in the future, especially because of, I see a lot of companies transitioning to working from home. So there's going to be, there's the home office now, and how is the impact of that commercial, potential hit there with companies not having office space? How is that going to affect the economy as a whole? So two-part question is this going to really make a big enough impact to change the way we look at real estate and the way we live and breathe it, and then the commercial factor and how that's going to impact the economy?
Certainly. And so let me start by saying that as of right now, and we obviously are all listening day to day on how this pandemic is developing, we're listening to the health experts trying to read the tea leaves if something's not quite clear. What we're getting at right now is that there is a potential for a resurgence of this virus in the fall, right? So there is a potential for some seasonality factor. From my perspective, that very likely will continue to impact the way we work, and just to your point, just as importantly, the way we think about housing. So from that perspective, I do see buyers actually demand more space, demand specifically for their homes, dedicated workspace. It doesn't have to be a big executive suite in your home, but it has to be a space that's enough separated with a door, at least in some windows, where you can actually conduct business. So I do see that continuing to play a very important role in housing going forward. And interestingly, when we look at on our platform, at listings that have the word office, we've seen that over the last few months, and even now into April, listings that actually had the word office in them, office, home office, or some derivation from that, actually fetched a premium, a slight premium, and sold a little bit quicker. So I think we'll see that. On the commercial point, to your second part of the question, I do see that having an impact on the office space. The impact to me right now is not as clear. On one hand, I would say with fewer people going into the office, demand for space naturally will decline. At the same time, what we're seeing from some of the Asian economies that are now beginning to reopen with a lot more health-minded features in place, we're seeing actually per employee space begin to grow again. After roughly 2 decades of shrinking, per employee space now for health reasons is growing. So as a result, some companies may actually retain the same amount of space, but have to allot more per present employee, while a good chunk of the workforce continues to work from home. So I think the jury is still out on what the impact for the office space is likely to be over the medium term.
I totally agree with all that you had said. I mean, just to highlight a couple of different things. I mean, on the residential market side, I mean, as you mentioned, that need for that home office environment, that also goes hand in hand with the technology. And I think that one of the great advantages of the Metro Denver region and all is that we are well served in terms of broadband coverage and that type of thing. So we were able to transition pretty quickly from that whole, work in the office to a work at home standpoint. But I think that, telecommunications then and all of the technology in the new homes is going to be absolutely critical. In terms of the commercial real estate markets, I agree that it's a little cloudy as far as the influence on the office space right now. I mean, there are some companies that are saying, hey, we've discovered that we really don't need as much space as what we had before. So I think that that's going to change some things, certainly on the office side. On the industrial side, which here in the Metro Denver region, most of the construction activity has been within the industrial marketplace, really more those logistics centers, the warehouses. And that is also critical for all the e-commerce companies then to be able to have those facilities close to the employment or the population concentrations. So that market I see still as being very healthy. On the flip side, the retail side, the restaurant side, going to go through some massive changes, obviously, when we talk about how many people can be in a store, how many people can be in a restaurant, you still have these strong fixed costs for these employers but now the number of customers is going to be cut in half or that type of thing. So I think that market is, that whole retail restaurant market is probably going to be the most challenged as we discover the new normal here.
So specific to real estate, what data points or trends are you really focusing on during this pandemic? Patti?
Well, from the residential real estate side, I mean, I track all of it. We look at what's happening in terms of sales activity, what's happening in terms of pricing, number of days on the market. We're also watching foreclosure activity, not that we see any of that showing up in any of the data right now, and also construction activity, because obviously how well we are adding new units into the marketplace has a tremendous influence on what's going to be happening with pricing in the marketplace. You know, and right now in the Metro Denver region, we're seeing that our construction activity on the new residential side is down. I mean, you know, for the first quarter, we're down by about 16% overall in terms of the number of new units being added, which was pretty much expected. We expected to see a slowdown. I think it will be very interesting to see in the second quarter the influence that has happened. I expect that we'll see an even stronger drop in that second quarter. So going back to one of the first comments that you had made about that it is indeed a tight residential market, I think that's going to remain the case, although the good news was that in Metro Denver, we had finally reached a point where we were kind of, our demand and our supply were in roughly an equilibrium. Moving forward though, again, that challenge in terms of supply is going to come rearing its head again, I guess.
Yeah, from my perspective, at the national level, what we're doing is looking at some of the higher frequency data from our own platform, right? So a lot of the main market metrics tend to be more monthly driven. And so we're relying on some of the insights we're getting, and we're publishing some of those on our blog on a weekly basis. We're looking at active inventory. We're looking at new listings coming to market, how they are performing. And of course, we're also looking at time on market and prices. And so with those, weekly indicators, we're getting a slightly more timely, I would say, view into how the market is performing. And aside from that, I think just as importantly is to look at some of the macroeconomic indicators, because obviously those will all feed into a lot of real estate activity, whether it's unemployment insurance claims, whether it's interest rates. Obviously, those all have an impact on real estate markets.
So sticking with housing, if I can ask you both, if you waking up on January the 1st, 2020, if you were to make a statement about real estate in the housing market on January 1, as opposed to today for the rest of 2020, how would that differ?
Well, I can say that when I was doing economic forecasts in the December, January type of time frame, I was one that stood up and said, no, we see no recession in sight. Definitely a slowdown in the marketplace, but we weren't expecting a recession. But I did also say that recessions are typically very hard to predict because they come from something generally unexpected. Well, wow, this was definitely unexpected. And I think so we were already expecting a bit of a slowdown in activity, a bit of a slowdown in terms of sales activity and employment and that type of thing, but we certainly were not expecting the extent of the slowdown that we have seen here.
George.
Absolutely. So January 1st, 2020, coming into the new year, we were looking at several factors that would define, from our perspective, this year's market. Number one, we were looking at slight economic slowdown. So instead of the 2.2, 2.3% GDP growth, we were expecting about 1.7, a little bit slower, but still growth. We were expecting employment to continue strongly. And for the housing market, just as importantly, we were looking at the 5 million, roughly, millennials who are turning 30 this year. Just think about that number alone. 30-year-olds just are going to be about 5 million of them this year. And when you consider that last year's housing market had about 5.3 million homes, it tells you the kind of potential we were seeing in the market. In fact, for us, the main concern for this year's market was the inventory picture, which was going to hold a lot of those people back. So fast forward to obviously today, we're in a different environment. We're in fact in an unprecedented environment. Even if you go back to the Great Depression, late 1920s, it was nothing. People suffer from job losses. What we didn't see before is an economy that was on purpose, basically put into a pause mode, broadly speaking. And so in this environment, it's much harder to quantify, number one, in a sense, what's the collateral damage, because there's always that. And number two, what's the path forward? So obviously this market in what we find ourselves, being that it is unprecedented, I think also makes it a little bit harder to necessarily see clearly the road ahead. Everybody talks about, well, we want the economy to rebound. Well, what does that mean? Simply put, it means that you and me and Patti are, in a sense, going to wake up come July 1st, right? We're going to wake up, walk out in the street, and basically go back to the store, go back to our jobs the way we did in January 1st. Okay, maybe any hangover notwithstanding, right? Well, the truth is that's not likely to happen quite as easily as that, right? A lot of us are not going to necessarily go back to work the way we did. We're not going to go back to shopping the way we did. With the negative impact on employment and our general confidence, look at the consumer confidence numbers, record drop this last month. So with that hit to confidence, it's very likely we're going to be more cautious naturally going forward. So automatically that means the economy is going to take longer to recover. And so for real estate markets, I see a slow recovery as well. Though to the silver lining to me is there are still a lot of people interested in purchasing homes, interested in making changes. The trick is, will they have the product when they want to move? Number one. Number two, will they be able to qualify for financing, right? That's the other part of this, is we're seeing banks become a lot tighter. You know, FICO scores are now much higher, 700 plus. Down payments are now 20% plus. So right off the bat, you're excluding most of those generally younger first-time buyers who would have come to market with a 5%, 10% down payment. Right now, they can't find a mortgage very easily.
So let me touch on that. In terms of the lending side of things, what do you see the current state of affairs there, and what potentially is going to happen with lenders, for the rest of the year? And also, do you see the number of forbearance applications having an impact on the housing market also in the future?
I'm going to let George take that one because that's a little out of my realm.
So absolutely. So from the way I see things right now, I see banks becoming a lot more conservative for several reasons. Number one, in a sense, from a regulatory standpoint, right? They have certain basically requirements in terms of reserves, in terms of downside risks to their balance sheets that they have to answer to the regulators, whether it's the Federal Reserve, FDIC, OCC. All of these regulators have told them to be a lot more lenient during this period, understanding that there's a huge social cost to this. So banks are working with people on forbearance. So I think, if anything, that is really helping the housing market right now. We would see a much bigger spike in delinquencies and distress were it not for that. However, going forward, banks are still going to be very cautious, in part because they have to take into account the macroeconomic environment. When they see people losing jobs, when they see companies moving to contain costs, they expect economic activity to slow. And with that, they expect the risk to them as lenders to also increase. So they obviously are going to be cautious. We've already seen them take steps in mortgage. Fantastic news. The trouble is, can you apply and actually get a loan at that mortgage rate? Maybe not so easily right now. So going forward, I expect the remainder of 2020 to see banks be very cautious. Some non-bank lenders might be more active in this space and provide some better product and opportunity for them for growth. But I do see that playing sort of a drag type role on the growth of the market. Looking far ahead, from my perspective, the way the Federal Reserve has approached to monetary policy this cycle depression, so they made a lot of accommodations, but nowhere to the speed and scale with which they acted this time. In fact, if you look back at the last 2 months, it was the Federal Reserve on March 3rd who literally threw the first shot across the bow of the economy, saying this thing is a lot more serious, when they made the surprise 50 basis point cut. And they haven't stopped since. They dropped the rates to zero. They've made lots of commitments to purchase basically bonds, to purchase corporate debt, to purchase mortgage-backed securities. So they, from my perspective, they threw everything and the kitchen sink to this problem, specifically because they want to make sure that the banking system and the financial system remains liquid. It provides a lot of funding for companies and for consumers right now in need as a bridge. Again, we are all hoping that this recovery will be fairly quick, but for that to happen, we need this financial bridge. So I see that as actually lending to begin to pick up slower than most people expect.
Okay, thanks, George. This one's for Patti specifically. How has COVID-19 impacted Colorado specifically, maybe as opposed to other states?
I think that here in Colorado, we've had perhaps a few different influences on our economic activity. I mean, keep in mind that tourism activity is really critical to our state. And so the shutdown of the mountain resort areas has had a very large impact on employment. And I think will also influence the housing markets within our resort communities. What are we going to see happening in terms of second home sales and second home development and the whole tourism roll into the state of Colorado? So that's definitely been different. Also, with the other thing that has been happening here in Colorado is the oil and gas industry. We have a strong concentration of activity in oil and gas. And so the very low prices that have happened are having a devastating impact on our oil producing areas, most notably in the Denver metro region, looking at the just north of us in Wells County, where we have a lot of drilling activity. And also we have a lot of oil and gas companies that have significant office operations, more in the downtown region. So these companies, not only are they seeing a lack of demand because people are not traveling as much, they're not getting on those airplanes, they're not even getting in their cars for that matter, but then you also have all of the supply issues that have been really driving the price down. So that's been an influence here in Colorado. On the flip side, kind of what has really worked well here in Colorado would be that we have a strong concentration of companies in that whole high technology space, whether it be aerospace or telecommunications or software development. And all of these companies are still moving forward. We're still deemed essential, still providing good, sound employment base here. And I think that kind of the whole diversification of our economic base is really what's going to help us find that new growth pattern eventually. That year from now, it's that very solid, diversified economic base, the types of companies that we have here that will really position us again for growth.
Thanks so much, Patti. That's really good. So for the two of you, what are the major indicators that you look for in a turnaround in the economy? And we all want to look in our crystal ball, but what does this recovery look like in terms of time frame?
Well, as I've kind of already said, I mean, our expectation is that it's not going to be until third quarter into fourth quarter that we start to see some glimmers of improvement, and really not getting into a solid footing again until the middle of next year. What we're watching very closely, because, at a national level, you can look at gross domestic product, GDP, what's happening with that as the broad indicator. It's looking at state GDP, the data is very lagged, so that's hard to use as an indicator. So what we're really tracking is employment. What's going on with employment? And that data is lagged. Because, for example, we're not going to get that glimmer into the April employment statistics until May 22nd. So we're still about a week out from really getting the full view of what happened to our employment base. Nonetheless, even though that data is lagged, that is certainly one of our key indicators that we look at. We also look very closely at consumer confidence, because obviously consumer spending activity being oh so critical to the health of our economy, to the health of our state and local government here too. I mean, we're hearing all of the news about our state and local governments really having to curtail their spending activity because their revenue is challenged. So that's another thing that we look at. We watch what's happening, obviously, in the residential real estate markets, because that's a key indicator as well of how consumers are feeling out there in the marketplace. So, you know, we want to make sure that I think what we have to make sure of is that people start to feel comfortable within our new reality. And until we get to that kind of comfort level, I think our economic conditions are indeed going to be a little kind of fits and starts along the way. It's going to be a little bit challenged until we figure this out.
Yeah, so from my perspective, to build out on Patti's points, I think that the first thing that we would want to keep an eye on is the health statistics. More specifically, we want to see the number of cases, of COVID cases, begin to decline considerably. We want to see the number of fatalities begin to decline considerably, because they will give us a sense of whether the efforts we've put so far in containing through quarantine, through all the sacrifices we've undergone, if these are beginning to pay off. Because there's obviously a real health impact, but there's also psychological components to the current situation. So until people can feel safer venturing outside and going about, and again, being human, socializing with other people, it's likely to constrain economic activity. Second, on the economy front, I would say it's important to keep, exactly as Patti pointed out, an eye on the employment situation, right? We have an economy, think about the American economy, we have an economy that's driven entirely by consumption. You and me literally going out and buying things, whether it's houses, cars, food, jeans, whatever it is, we drive the economy with that consumption. Well, what drives that consumption is income. And right, for most people, that income comes from their jobs. So if people feel secure in their jobs, if people feel that the outlook looks positive and fairly safe, they're more likely to spend. So from my perspective, job situation, the unemployment rate, and specifically the broader unemployment rate is just as important to keep an eye on. Once we see that stabilize and begin to move in a positive direction, I would say in aggregate, we're all going to feel a lot more upbeat about it. The timeline, to your point, Ewan, I see this as really being possibly somewhere in the second half of 2021. When you look at most recessions, the recovery period for most recessions tends to be roughly about 2 years, give or take. The last one, Great Recession, was at least a 2-year period of before we saw a significant turnaround. The severity of the current one is much deeper, right, than that one. And so even a quick rebound won't be nearly as quick as most people think. So that's why I see mostly the second half of 2021 showing a more, I would say, upbeat outlook.
Okay, I'm an optimist by nature. That's just me. I'm always half glass. The glass is always half full for me. Give us something to finish, one thing to be hopeful about within the real estate market, and then something else within the economy that we can, be hopeful about. So, I like to end on something positive here, guys, okay?
Well, I'll start with that because I share that type of optimism there. Again, moving into a recovery phase, I think we need to recognize the resilience of our people that live here, the resilience of our businesses that are located here. We are social animals. We want to be a part of everything that is happening. And I think that we will discover the new ways of doing business, the new ways of getting things going again. I mean, that's I believe is kind of human nature here. We're going to, you know, when we see a business community that is indeed very creative as far as how they need to get their goods, their services out into other people's hands. And I think that that whole creativity, that resiliency will really do us well here in Colorado. And also, again, I go back to the whole issue of the diversification of our economic base. Because we have a very diversified economic base, because we have some good concentrations of those critical industries right now, I think that that positions us well for economic recovery. It's going to take some time, no doubt about it. But I think that, again, we here in the Metro Denver region are ones that we're really looking at ways to keep us moving forward, and we'll find that path.
And to your point, I like you calling, dismal scientists out whenever you sense a little too much of the glass is half empty. So let me say that on the upbeat side, I revert from my perspective. I revert to really several things. Number one, think about the fact that 100 years ago, 1920s roughly, about 40% of the U.S. Employment base was involved in agriculture. Today, that percentage is less than 2%, okay? So what does that mean specifically? It means that with the advances in technology, our employment and industrial and business landscape looks so different. Look at the fact that even with an economy that's shut down, and even with an unemployment rate, which is tremendous, right? It's extremely high. We still have millions of Americans who have been able to maintain productivity and maintain companies in business working from home. And technology has made that possible. And for me, that is a really, really strong foundation looking towards the future. Number two, I look at the demographics of the country. Think about the fact that over 60% of the US population is under the age of 50. That's tremendous. If you have an economy dependent on consumption, you want a population that's younger and that's growing. And the US has both of those in spades. So I think with this younger population, we're going to see continued demand for goods, for services, and just as importantly, for real estate. And third item, and I think this speaks very well, and Patti very much mentioned this. We as humans very much, and this is a process of tens of thousands of years of living together and evolving together. We want to be with other people. In as much as I have watched the doom and gloom in the retail space and sort of the death of retail stores, I'm not as bearish on it for a simple reason. We've had markets where we come together for thousands of years. Yes, the current e-commerce, the benefit of being able to shop online wherever you are is a huge bonus. But at the same time, we still want to do business face-to-face. I don't see we're going to give up on seeing homes in person. Yeah, more of us will actually see the virtual tours first, but we want to get a feel for a neighborhood, a feel for a home. So I think that, from my perspective, is what is going to underpin our recovery and our road going forward.
Fantastic. I think I agree with all that. I think that's the foundation that this country's been built on. We've faced many tough economic times, tough times without any doubt, but we've always been able to come out through them. And I think real estate has always been a real indicator, and in terms of coming out of these tough times. So I want to thank Patti and George. Tremendous insight, not into just the real estate world, but the overall larger picture of the economy, locally. Patti, thank you so much for your insight, and George, it's a great perspective to get on the national level. So just can't thank you enough for taking the time today to spend with us. Just to finish up, I'm just going to let everybody know that we're going to continue these virtual presentations. Our members can email us at communications@dmarrealtors.com if they want to request any specific topics to cover in the future presentations. So, and you can comment on our social media as well. But thanks again, Patti, George. Have a great rest of your day, and hope to bump into you soon in person.
Exactly.
Likewise, same to both of you.
Thank you.
Bye-bye.